Hi, my name is Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled you're here. And we're going to have a lot of fun today because we have Mauricio Rauld back on the show. And if you don't know Mauricio is an SEC attorney. And the topic today is keeping your butt out of jail. So we're going to have a lot of fun with this today. And welcome back, brother. Good to see you.
Always good to be back and talking to you, Rod.
All right, thank you. So let's talk about, because I know you just did a book on this, right? So what's the title of the book?
It's an ebook. I don't want to get too carried away, but the 5 things every syndicator must know to stay out of jail. Okay, that sounds a little bit important. So let's get into it. So tell us what's in the book. Tell us. Start talking about some of these things. Yeah, I mean, I've been doing this for a long time. So this was kind of the 5 things that I was seeing out there that people were just continuously doing wrong without really knowing it. And I know the title's a little bit out there, and I thought about changing it, to be honest with you. I thought, maybe that's a little over the top. Because look, the reality is, unless you're defrauding your investors, right? Unless you're Bernie Madoff and you're intentionally doing harm to them, you're probably not going to be going to jail. Like, it's certainly possible, but that's really not what it's there for. And so I thought about changing the title, but look, what I really wanted to emphasize was when you violate these rules, these securities rules, that's a big deal. You know, even if you don't go to jail, you're committing a felony. You could go bankrupt. You've got to return all the investors' money with interest, which you probably don't have. So I really wanted to emphasize that these are, a lot of people just take these rules kind of like, whatever, everybody's doing this, and it's really serious business. And so that's kind of why I stuck with it.
Well, listen, I happen to personally know a couple of guys and heard through the grapevine that, they're being looked at right now by the SEC for some of this stuff. So it's not, listen, that is a door knock you do not want, the SEC. So, what are some of the things you're seeing, Mauricio?
Well, let's see. The first thing that comes to mind, which happens all the time, is people either don't realize they're selling securities, especially if you're a first timer, or along those lines, really maybe the worst one, is people know they're selling securities, but they try and get cute and they try and structure it in such a way that they believe is not a security. And the most famous one that you and I have talked quite a bit in your presentation seminars is sort of the joint venture thing, right? Hey, let me structure this as a joint venture because then it's not a security and I don't have to worry about it. Or maybe I'll do a profit sharing agreement, a handshake on the side, and I'll give them money that way. And somehow they think that gets them outside of the securities laws. And it's not just syndicators, Rod. I've been talking a lot with lawyers, so it's not like it's something that everybody should know. Lawyers who don't practice this don't know this either. And so they're advising their clients sometimes, well, let's just put an operating agreement together. Let's put this thing together. And luckily they get advised that, hey, you may want to check with the securities lawyers because this is actually putting together a syndication. So that's probably the first one that I like to start with because that happens all the time. Like that's
let's drill down on that. Drill down on that. And I tell the story at my events that, I bought a lot of property in my 20s, like millions of dollars worth of property, 50-50 with partners. They put up the money. I did a lot of the boots on the ground stuff, but they were involved because they signed on the debt. And if I spent more than a certain amount of money, I had to get their written approval. So they were actively involved, and that might be right on the edge of it. But if they signed on the debt, they're active for sure, right?
I think if they sign on the debt for sure, and with 2 people, the easy way, because you're right, the key is to make them active. Like everybody needs to be actively participating. The key on a security is when you're doing all the work, when the returns are being generated by your hard work and your efforts, that's when it becomes a security. So as long as everybody signs on the debt, that's a good one. If there's 2 people, just make each other a co-manager, meaning both has to make decisions. And actually, Rod, you don't actually really have to be involved in the day-to-day operations, but all of the important decisions, make sure there's a vote. If you're 50-50, then it's just a 50-50 vote. If you want to buy the property, sell the property, hire a property manager, refinance. I mean, these are obvious big decisions.
Right, and that was all in my back then. It was limited partnership agreements, and we were both GPs, as it were. Or we had entities that were GPs, if I recall. I don't even remember. It's been so long now, but okay.
You're painting yourself, Rod. Yeah, right. I know. Oh, trust me, I know. This is before they could spell LLC. I know. The pterodactyls were still flying in the sky. Right. All right.
Yeah, so that's a big one. And the other one that I'm still working on doing, you and I talked about this the last time too, you have promissory notes. For some reason, people think that, hey, I'm going to do a note and somehow I completely remove myself from the world of securities law. That's also a misnomer. And notes are their own animal. They have actually a different analysis, which is why I want to really do a deep dive. But just because you do a note instead of selling equity in your LLC or membership interest doesn't get you around the securities laws. So that's the big one, because people are then out there. Remember the rule from I don't want to repeat what we did in episode.
No, it's okay. It's okay to be a little bit redundant.
Episode 353.
Okay, there we go.
Remember, when you're selling securities, you've got to register the security, find the exemption, or it's illegal. And so if you don't realize you're selling securities, then you're obviously not going to register it, and you're not paying attention to any exemptions. So then you're stuck with an illegal offering. You're selling securities without registering or finding exemptions. And that's the problem that if the deal goes south, that's the problem you're going to find.
Right, right. And, guys, you've heard me say it. The proverbial stuff is going to hit the fan here, and it's coming. And so, I had the economist Harry Dent speak to my mastermind a couple of weeks ago, and he just reaffirmed. That's his shtick. Is he's been he predicted 08 and 9. Had I listened to him 23 years ago, I wouldn't have lost $50 million. And that's why I was excited to get him to speak to my mastermind. But he says it's coming. It's going to probably last till 2023, but it's going to be ugly. And so some of these deals are going to go south. And I'm going to tell you, when that happens, governmental agencies make examples of people. Now that's the worst that could possibly happen to you, because then you're in the news and everything else, and then then there's a more of a push to really slap you. So that's a bad day.
And we talked about that in the last show, but we talked about it's all going to go south when things start to go down. But as you mentioned, there's a couple of SEC investigations going on now, like before what hit the fan. So I can only imagine what it's going to look like when investors, because that's when it starts, right? When investors start losing money,
the
first thing they do is
complaint driven.
And they complain.
It's complaint driven. Yeah.
Yeah. And maybe let's talk about that. They pick up the phone, they complain, and then the first thing the regulator, it's a state regulator, the SEC, they open up an investigation, they open up a file, they do an audit, they request all the docs, all the information, and that's when they start figuring things out, and there's somebody in there doing their investigation, and that's when all this thing starts coming out.
Right, right. So we talked about a joint venture and how everyone needs to be active. I want to drill down just a little bit more on the loan. So if someone goes to someone and like hard equity and says, "Hey, loan me the money to do this deal," at what point does it become a syndication?
If you're doing a note, if it's one note, it's not fractionalized. So that once you get into a fractionalized note, that's another whole area as well. But if it's one note and it's secured by real estate,
yes,
and it's truly secured, there's enough equity where if you don't pay the loan, I essentially take back that property, so I'm kind of covered. Then you're falling within one of those exemptions or family.
Oh, good. Okay. So hard money in this case doesn't apply if it's based on the equity. Okay. Right. It's where it applies is if you're throwing a note at it, but it's not secured by the real estate, or there's not enough equity to account for it in the real estate.
That's right. Got it. You're in third position, or you're underwater, what have you. So if it's a note that's secured by a mortgage, I mean, you're in good shape. But once you fractionalize it, then it becomes an investment contract. So you definitely don't want to fractionalize it. The other
so when you say fractionalize it, where you take a note and let's say it's $1 million and you allow 10 people to come in for $100,000 a piece and pay them a return.
That's right. That's going to be hands down. It's going to be a security.
No question.
The other thing that I want people to be aware of, again, without fractionalizing, but another common situation when people are flipping deals, right? They go in, they buy the house, they get a loan for 6 months, 5 months, or whatever, and they flip it. Anything less than 9 months, by definition, is not a security. So a loan that is 9 months or less is not a security. So most of the time, it doesn't really help you. But if you're in the flipping business and you only need the loan for 3 or 4 months, or 6 months, or 8 months, that's something else that might help. But that, by definition, is not a security.
Okay. So we've done joint ventures. We've done notes. What's next?
The second big thing is, we and I talked about, let's pick our poison. The next one is probably the advertising, right? That's the second thing. You've got to understand that the SEC has a zero tolerance policy on this. And for some reason, people think they can post on, so for some reason, the social media doesn't seem like it's the same as taking out an ad in the Wall Street Journal or the LA Times, right? And so and everybody does it. And so people start posting not only about their deals. I've actually seen posts, and again, maybe these posts allow advertising. So I'm not saying all these posts are illegal, because there are certainly some exemptions that allow you to advertise. And in those situations, you can do whatever you want. But if you can't, there's two types of posts that I see. One is the flat out, hey, I'm raising money, call me, which is clearly in violation of those rules. And then the other thing is, is this conditioning the market concept, which even if you're not talking about your specific deal, but you're posting something that clearly is drumming up interest and excitement about a current deal, or maybe even a deal that's coming down the pipeline, that can be considered conditioning the market, which is going to be advertising, which is one of the reasons I recommend to all my clients that if you have an active deal, I would stay off social media. I mean, you can post about your cats and your family and all that stuff and your kids, but don't try and get cute about posting. My favorites are the ones that get posted on their due diligence trip. Hey, we're doing due diligence at the property today, and there's like a little video on that. And there's a way to do it that you could probably get away with not conditioning the market, but people can't help themselves. They always bring up the offering or call me and investments. I mean, that's why they're posting, right?
Those are my most heavily watched videos. I literally just did one a couple days ago, and they get upwards of 5,000 views. But I'm doing 506C offerings, so I can, pretty much shout it from the rooftops. And what he's talking about, guys, here is 506B, which was the original, exemption, and you have to have a substantive relationship with those people. Yeah. And that doesn't mean social media. Doesn't mean at all. Right. So
yeah, and if you're doing it, let's take that. So I think this is a good example. This is probably I should probably talk about this more often. So let's take that event. You're at the property doing your due diligence. Obviously, you do 506Cs. You can do whatever you want. You could literally tell people, we're in the middle of this deal. Call my team if you want to invest. But if you're not, you could, in theory, do a value add video, right? Take your camera and say, look, here are the top 10 things that I look for when I walk units, for example. And you take your camera and you go through a unit and you point out the 10. It's got nothing to do with your offering. It's got nothing to do with conditioning them. You're literally delivering pure value to your audience. And that's the way, in my opinion, the best way to use social media is get that value add type of information out there. Get that information from the person consuming your content, and then start a relationship. Start building that substantive relationship, which you just mentioned, Rauld, which is really what 96% of the people rely on in order to avoid advertising rules, is having a substantive relationship with the investors and using social media, not in the middle of a raise, but in between raises, using social media to get people off of social media and start that relationship building. That's the way I think you should go about doing the social media.
So you could actually do due diligence on an asset you're raising money for. If you didn't, and I don't want to get people are going to, what if I say that they're going to see it, they're going to try to weasel through it. So I'm not even going to suggest it. But the bottom line is, if you are adding value, and that's what I try to do on mine. I talk about the little nuances, like I just did one on our property management changeover, and I was doing one on sequencing make readies and project management for a big big reposition. Most isn't 85% of the market 506B where you've got to have the relationship?
It's actually more than that. I mean, it used to be 90-10. Now I saw the last statistics. It's almost like 94-6. I mean, it's really, for some reason, I don't know why. I mean, you do 506Cs. It's not.
All I do is see. You can't advertise with a B. It's just so surprising to me. And maybe it's just everybody's doing friends and family or something. I don't know.
I mean, one of the reasons I appreciate this is you've got to remember, like, our little niche here is very small, right? I mean, the amount of people that are doing what we're doing. I mean, most of the money is raised by Goldman Sachs, JP Morgan. They all use broker dealers. Broker dealers have relationships with them. So that's really, I think, why they don't need to do 506C. They're using brokers to do their thing. So I think that skews the numbers a little bit. Certainly in my world, let's take my world, for example. For my clients, I would say it's closer to like 70-30, 80-20.
Okay. Still high, very high. Yeah. Okay. Yeah. Why do you think that is? Why do you think so many people are doing B instead of opening themselves up to have the ability to advertise?
Well, the main reasons is with the 506B.
More people.
Well, you can't. You cannot take a non-accredited investor.
Right. So it's more people. Yeah.
Yeah. You're swapping the privilege of doing advertising, but then you can't take any non-accredited. And a lot of first-time syndicators or people who just are comfortable. You may have investors in your deals. You may have done 5 deals. You've got non-accredited investors in the deal. You don't want to shut that money out.
Yeah.
That's
got
the main
it.
reason.
Yeah, of course. I should have thought about it. Of course, that makes complete sense.
Yeah.
You're going to have a much bigger pool to fish in the 506B, but you can only fish with people you know. That's the thing that's the limitation that people stretch the envelope on.
And you've got to worry about all these gray areas. I mean, a lot of these things that we're talking about, they're great. What do you mean? What does conditioning the market really mean? I mean, we don't have any clear guidance on that.
So talk about that. Drill down on that a little bit, if you would, please.
Yeah, I mean, there's some things that are clearly conditioning. I mean, for example, if you go there and you start talking about how amazing your investors do really well, and you typically give them 10% returns or 12% returns, and that's obviously something that you're getting people excited about. But there's a lot of things that are on the fence. I mean, that due diligence video. I mean, if you're doing a pure value add, but then you kind of sneak in there, hey, for more info, click here or call me to find out how, ask me how, all that kind of stuff. It gets a little bit tricky. And I just think you're playing with fire. And because of that, I think if you're going to do it, like the video we talked about, doing the due diligence video, I would record it at the due diligence, but don't release it until you're done with your offering. So there's really no debate. There's no risk of anybody saying, well, that was really a video to get people excited about your deal. Everybody knows you're doing a deal and they're going to contact you because you're well known in the industry that you're in the business of acquiring properties, and therefore when they saw that video, they knew you had an offering in place. So, so that's kind of one of the great. But the 506C is such a great, if you can get around the issue of non-accredited and stick to accredited, it really opens up your entire world. Right now, you can market, you can go on podcasts like this, or you can have a podcast, and you can literally scream from the top of the mountain, "I have a deal, come talk to me."
Right. Okay. So conditioning the market and examples would be talking about previous deals you've done and the returns you've gotten and just anything that juices people about wanting to do business with you would be considered conditioning.
Yeah. Or even that post where you don't have to reference a deal. Like if you have a post and you say, hey, if you want to find out how to invest with us, call us. You're not really talking about a specific deal, but that's clearly a conditioning the market issue. So
even just letting them know that you raise money in the future would be considered conditioning the market.
Yeah. The only things you're allowed to technically do are factual information about you and your business. You can always post about that's why I like the post about, hey, we acquired this property last year and we retrofitted the pool, and here are some pictures of our beautiful new pool.
But can you talk about the numbers even if they're factual?
Yeah, I wouldn't talk about the numbers. I mean, you can talk about, hey, how much it cost you, but I certainly would not be talking about, what that translates into a higher NOI, which translates into a return for your investors.
I've seen contemporaries, even high-level contemporaries, do that, and one of them I've heard is being investigated, where you're talking about turning it around, increasing the NOI, and here's how much equity we've built.
I think that's where you cross the line. You started with a value add, or in this case, it would be a factual. There's nothing wrong with you telling them how your business is doing. But people can't help this. I'm telling you, people cannot help themselves. They have to squeeze in and by the way, this really helped our return for our investors and all that stuff. They just can't help themselves, which is why I prefer not to do it while you have a specific deal.
Wow. So what else? What else is out there that you're seeing?
The other one, which is specific, we talk about these contemporaries, that there are at least 2 SEC investigations that I'm aware of, and they focus more on the raising capital for other people, this infamous money raising thing, because it's very tempting. Raising money, at some point you run out of the people and if you can't advertise, well, where do you get the money from? It's very tempting to start partnering with other people and bringing in what we call money raisers who have the ability and the scale to go find $1 million or $2 million for you. It's very tempting to bring them in and give them a piece of your deal in exchange for that, for that money that they're bringing in. And everybody's doing it, or at least, it's interesting. I think everybody was doing it, Rod. And, at some point it started to get talked about a lot sometime, I think, in the middle of last year. And I'm not exactly sure what the trigger was.
I think you played a role in that, my friend, okay? Because you're out there quite a bit, with your flip chart telling people about this. So I think you were probably a big a catalyst for that conversation. So what else can we, is happening that you're seeing out there, Mauricio?
Yeah, well, I mean, we've been talking about these two investigations. At least I'm aware of two. There may be more where, and they're focusing more on this issue of bringing in money raisers to help you with the raise, right?
Right.
It's very tempting because it's not easy to raise money, and so especially as you get larger and larger and you run out of your own capital, your own friends and family, that it's very tempting to be able to bring somebody else in who has the ability to go raise a bunch of money for you and then pay them typically with a piece of the GP or shares in the company or some kind of compensation. And what most people forget is that you can't do that unless that person is a licensed broker, right? Which of course they're not. I mean, if you want to employ a broker dealer, that's fine. They'll charge you a commission to go raise money for you. But those guys aren't getting out of bed for less than $20 million anyway. So that's why it's not really something that I see that often. But in order to bring somebody in to raise money for you, I don't even want to use that term because again, money raising in and of itself is not right. They've got to be a legitimate co-sponsor of the deal. They have to be doing real work, active role. They've got to be doing everything that everybody else does. You've got to be involved in the acquisition, finding a deal and vetting the deal and doing the due diligence and doing the underwriting. And then once you close on it, you've got to execute on the business plan. You got to asset manage it. Then you got to sell it. All that, not everybody has to do everything, but you've got to be involved in those types of duties. And the key words that we like to use from the statute, because just to backtrack a little bit, in order to get around this issue of you being a broker, you have to rely on what we call the issuer exemption, right? And the way we rely on the issuer exemption is for you to be doing substantial work, substantial duties. It can't just be, I'm just raising money. I've got to be doing one of these things that syndicators do. And that has to be your primary role. Your primary role has to be doing whatever it is you're doing.
So it can't be just raising the money. It's got to be being involved in the due diligence, doing the analysis, and then maybe involved in bringing that deal to closing, involved in the financing, signing on the debt maybe. But at the very least, being actively involved, maybe involved in the asset management after the fact. The investor relations can be a piece of it. But it can't be all of it.
Can't be all of it. And I think the asset management piece is an important piece. I mean, if you're just involved in the beginning in the offering, and then once you close, you go home, that's not looking good either. So you really want to be as active as possible in that area. And where people are really not even coming close to this, I mean, the things I've seen from people are for me, cringeworthy, is where they're getting paid what we call transaction-based compensation, meaning literally, if you bring in $1 million, I will give you X percent. If you bring in $2 million, I'll give you more. Or if you don't bring anything, I'm not going to. That kind of stuff is blatantly broker-dealer activity. And so that's the first thing you want to avoid. I mean, if I'm going to give you a good recommendation is don't pay people based on how much money they can bring in, and make sure they can add value. I mean, I've seen people bring in sponsors that have never owned a piece of real estate in their life. I mean, what value are you adding to this whole process if you've never done a real estate transaction? I mean, maybe you can help out, at the beginning, you're learning and maybe you're a 1 or 2%, kind of learning the ropes. But that's a big one. And that's one that I'm actually, I hate to say this, but I'm actually looking for, I obviously don't wish anybody harm here, but we have a lot of uncertainty when it comes to the substantial duty part. Like, what does that mean? Right? Just like
it hasn't been litigated or anything yet. There's no case law yet. Right.
There's a lot of stuff about transaction-based compensation. That's easy. Right. Primary to me is easy because it just means you spend more time than not on something. But, like you said, does investor relations alone, is that a substantial duty? Right. Right. And I think of it as a sliding scale, Rod. I think the more ownership you have in the syndication and the more money you're bringing in, the more burden you have to show that you did substantial duties. If you're somebody who has a 2% ownership, isn't doing much, brings in 1 or 2 investors, you probably don't have to show too much, right? But if you're getting a significant chunk of the dough and you're bringing in a lot of the money, I think that's where the pressure starts mounting.
Okay. And circling back to the transaction-based compensation, guys, I have heard of every iteration of an attempt to circumvent that you can possibly think of, a marketing fee, a whatever. Listen, guys, if it walks like a duck and talks like a duck and smells like a duck, the SEC is going to know it's a duck. So don't think you can get around this stuff because you can't. You just can't. So do it right or don't do it at all, because you will get your butt kicked if you try to get over on them, because they're not stupid. And I know you agree with me here, Mauricio.
I'm so glad you brought it up. I mean, marketing fees, consulting fees are probably the two most common ways people think they're getting around it. And let me tell you, the SEC knows exactly what you're doing. If anything, it's probably a red flag if you have a consulting agreement or a marketing agreement. Similar to what we talk about generally, you know, of how you structure your syndication. How you structure that compensation is completely irrelevant. The SEC is going to go right through it. And if you're claiming a consulting agreement, for example, you better be able to prove what consulting you did, and your compensation for that consulting better be in line and reasonable to what you did. So you're going to have to show, you know, phone records or minutes of meetings or just something that proves that you actually did that consulting. And of course, it doesn't look great if you're doing consulting and then they're going to find out that you were responsible for bringing in $2 million of equity in the deal. Trust me, when things go south, your investors will not be your friend. They're not going to be telling the most rosy picture of you. They're going to do the complete opposite. You may not even think they're truthful, but they're not going to be your friend if there's an investigation and they've lost all their money.
Nope. So if we haven't sufficiently scared the crap out of you, then we haven't done our job. But I do want to swing the pendulum the other direction and say, listen, just about most of the people out there are doing this right. And they're not trying to screw people. They're not trying to circumvent the law. And it's just an education process. And, you know, Mauricio speaks at my 2-day and what used to be my live 3-day boot camps. And he just spoke at the last 2-day we had. We had over 700 people there. And the one before that, we had 900. But, you know, so it's just an education. You've got to learn this. You can't dabble in this, bottom line. But it's not something to be afraid of or intimidated by. You just have to know it, right?
You just have to, look, you're obviously working with an attorney, right? This is not a do-it-yourself project. So you have an attorney. That's what they're for. They're there to guide you through and make sure you don't step over these landmines. And then getting the education. I mean, that's why I love your programs, Rod.
Thanks.
Just having that education piece in there, it just alleviates a lot of the risks because you're now aware of them. You know how to communicate with your lawyer. And look, this is one of the greatest ways to add value to your own people, to your investors, to the community. It's such a great vehicle for wealth creation that I don't want to scare people off. I want people to take it seriously though, and educating yourself and just making sure you've got an attorney.
And don't try to be sneaky. Just do it the right way. It's, you know, you cut a check to Mauricio to get it done right. And that's what everybody does. And don't overthink it. It's not overwhelming. It's not intimidating. Once you do the first run, you'll be like, is that all there was? But do it right. Don't try to be sneaky about it. So how can people get your ebook here, Mauricio?
You know, they can just shoot me an email at jail.
Seriously?
Yeah, it is. It's jail@premierlawgroup.net.
Oh, that's really funny.
Premierlawgroup.net, and that'll get automatically sent over to you.
That's really funny. All right. Well, and again, he speaks at, I've got my next boot camp coming up in October. I don't know the dates off the top of my head, but if you're interested, I think you can still go for less than $97. And it's multifamilyvirtualbootcamp.com. And he'll be speaking there as well as, other people and teaching you this business. But listen, brother, I appreciate you being on the show. It's good to see you, man. And, always adding value. Hopefully we'll get to see you at a live event one of these days soon when the world opens up again.
I miss everyone, man. I miss everyone.
Yeah, right. All right, man. Well, listen, thank you so much. And appreciate you being on the show.
Thanks for having me, Rod. Appreciate it.
All right. Take care, buddy.
Rod, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. Now, I know you've been hard at work helping our Warrior students do just that using our ACT methodology, which is awareness, close, and transform. Can you explain to the listeners how they can get our help?
You bet. Guys, we've been going nonstop for 3 years, building an amazing community of like-minded people. And our coaching students, which we call our Warriors, have had extraordinary results. They've purchased thousands and thousands of units. And last year, we did over 1,000 units with our students. And we're looking to grow this group and take it to the next level. We're looking for people who want to follow a proven framework that's really step by step and then leverage our systems and network to raise equity, to find and close deals, and to build partnerships nationwide. Now, our warrior community is finding success in any market cycle. So if you're interested in finding out more about how you can become more of our incredible network and take advantage of the incredible opportunities that are coming very soon, apply to work with us at mentorwithrod.com or text CRUSH to 41411. That's mentorwithrod.com or text CRUSH to 41411.